Hello and welcome to Welcome Home Radio. The waters in the mortgage industry can be pretty muddy, whether it's investing, leasing, renting, home insurance, or myths and misconceptions. Welcome Home Radio has the answers for you, the consumer. And now, to help you make the right home buying decision for you and your family, here are your hosts.
And welcome to Welcome Home Radio. It is July 13th, and I hope everyone is staying cool outside here in Texas. Redfin made an announcement today that listing prices are dropping nationwide. In fact, selling prices above asking are down from 53% all last year to 52%. Average percentage of price sold above asking has dropped as well, and accepted offers in the first 2 weeks has dropped 2%. Average list contract time stays about the same, 18 days. With last week's GDP report makes it 2 quarters of negative growth. Q1 was a negative 1.6, and the announcement is negative 2.1. Historically, this means we are in a recession, but this will not be announced until the NBER, National Bureau of Economic Research, reviews the data, and that could take up to September as late as October. The Fed is fighting inflation with raising Fed rates. Many people think this directly impacts housing rates. We will discuss a little bit today, but the answer is no. It does not directly impact the mortgage-backed security rates in the 15 or 30-year or anywhere. Labor slowdown shows an effect. The total amount of job openings has dropped over 400,000 last week and can be an early sign of economic slowing or just a pause in hiring for the quarter. With all these changes in the market, with all the swings in the mortgage-backed securities so large in the market, we want to have a market status discussion today, give you insights to the market conditions and what we might see in the near future. Joining us today is Greg Potts with Social Realty Group at Compass. Welcome, Greg. Glad to have you.
Thanks for having me on, guys.
And, of course, Tom Allen. Hey, you staying cool out there, guys?
Very cool.
Very cool.
Well, I'm the coolest of all of us.
Well, because you shaved your head again this morning. That's good. And I'm sure our head monkey butt will make us all into the four corners of the picture, but welcome, guys. I really am excited about today's show just due to the fact I want to gain some insight into what's happening in the market. There's a lot of things pointing to a slowdown, changes. And Greg, Alan, you can give us insights. Homes are staying on the market a little bit longer. Prices aren't being accepted. Has it slowly or is it quickly changing from a seller's market to a buyer's market? What is your opinion?
Greg, go ahead.
What I'm seeing right now is the initial shock of the interest rate hikes. I've been in new home sales and resale for over 20 years now, so I've kind of seen the shock of interest rate hikes in 2006 and 7 up to the crash in 2008 when I was in new home sales, and it's kind of reminded me of that. Ultimately, when the prices went up so high, then the interest rates went up even higher than they were. It just caused a panic in the local market more than anything. So what I'm seeing out there with my listings on the listing side, a listing that should be in the hyper sellers market we had over the past year and a half, a listing that should have 20 to 30 showings in a weekend and maybe 6 to 10 offers is getting maybe 5 or 6 showings in a weekend and getting 1 to 2 offers. So that's happened on a listing I had at 680,000 in Viridian. There was no other competition on the market too. There wasn't a lot of homes sitting around either. So that was interesting. I thought I'd definitely get 10 to 15 showings and probably 3 to 5 offers, but I got about 6 showings, 1 offer. But all we need is 1, right? So what I'm really seeing is more of a pre-COVID sellers market, a little bit more like that, to where homes are on the market for what I'm seeing on my listings, but homes are on the market for, I would say, 7 to 10 days versus 3 days or 1 day. And we're getting less traffic, less offers, but we're still having strong out-of-town buyer offers. So the people moving in town are the ones that are kind of, able to pick from the homes that are available right now. I'm not seeing any local offers on my listings. We just listed with Ethan Blair a home this past weekend. And this is a home in Summer Creek Ranch in South Fort Worth, and it was only $350,000. And they completely did everything we asked them to do. We asked them to repaint, stage. We told them the market's changing rapidly. There was some competition on the market, and that we did need to be the prettiest penny in the bunch if we wanted to win those offers. We got 4 showings and 2 offers. So in a 350 market, right? And this is this is Fort Worth. So, we're just really seeing on the showing side, less traffic, less offers, and the offers we are seeing are more from out-of-town buyers. Go ahead.
Well, I'm sorry. I wanted to ask a question. Is this slowdown, it seems like, is it due to just basically summertime and we see vacation family being a priority? Because I still see people moving here. I still see things. Why would we have a slowdown if that's the case? I'm trying to balance things out here.
Sure. Kind of the perfect combination of, kids getting out of school. As soon as kids get out of school, like you said, everyone goes on vacation. And not only the buyers go on vacation, but the realtors go on vacation. So realtors are on vacation and reachable. Clients are trying to see homes. And so, there's definitely going to be a slowdown for that reason. And we should see that change. If that is the case, if it is the vacation piece of it, we should see that change next week. It's usually around the 16th of July when that the traffic starts to come out of vacation mode and back into focusing on getting back into school mode. But there's definitely some of that going on. But it was a pretty drastic change overnight as far as showings on listings. And then on the other side, with my buyers, I've helped 3 buyers get homes in the past month. And every single one of them was in a power position to negotiate. So that was a little bit different than what we're used to. And the buyers on my listings were in a power position to negotiate. So, I hear a lot of realtors posting stuff on the market's not changing, nothing's changing. But I'm like, I'm out there selling homes, and power position is definitely changing right now. How long will it last? I don't know. But I definitely think
help our listeners understand, what does it mean, a power position? What do you mean by that?
So sellers have been in the ultimate power position for the past year, post-COVID, post-2020, between the end of 2020 and all of 2021, into early 2022, the sellers, hyper sellers market put the sellers in the power position, meaning they didn't have to do anything for anybody. They were getting tons of showings, no matter what their house looked like, no matter how much they priced it at. For the most part, the market was saturating those homes, no matter what. So sellers didn't have to do as much to prepare their homes for sale. They didn't have to stage as much. They didn't have to declutter as much. There was a lot of things they didn't have to do. And then when the offers came in, they had so many, they didn't have to negotiate. In fact, all the offers were coming in way over asking, with appraisal waivers, meaning that if the home appraised low, that the buyer was going to cover the difference. And then they started going to no inspections just to win offers. There were so many offers that people were foregoing the option period just to win the offer and putting themselves at risk. And it just got a little out of control for a while there. So that's a power position, meaning the sellers are in the ultimate power position where they don't have to give up anything. In fact, they can demand whatever they want, and usually 9 times out of 10 get it if they're in a really good area, really good house. So now, like I said, the power position is shifting more even. It's not like all on the buyer side. We're not in a buyer's market. We're more in a pre-COVID seller's market, maybe even a little bit more like 2018, 2019, when things had just started to calm down a little bit and our homes are sitting on the market a little bit longer. But, the months of inventory don't suggest we're definitely going to a buyer's market anytime soon.
And again, the economic news shows that selling prices haven't dropped like out of the sky, but they are moving downward. I was shocked to see one of your contracts. Actually, the seller was paying for title. The seller was paying for a survey if it needed. There were just indicators that kind of showed what you're expressing here. And I think that's important that our listeners understand. As you said, we're not in a buyer's market totally, but we are headed that way, at least the indicators showing, and negotiation can take place. I have another realtor that has a listing, and the buyer, because they have to have X dollars out of this to pay for their new construction home, has to leave it at the price they're at. They've cut as much as they can, and they're still not, they don't know if they're going to get a buyer. It's been on the market initially, and I think they just caught it at a downturn because it's at $224 a square foot, and they were expecting to hit it at the pinnacle as opposed to, and I think they waited a little too long to sell. So we're going to find a lot of that happening. Is that right, guys? We're going to find people.
Well, another indication, Blair, is the builder market. And Greg knows this. They went from, you're lucky to get 1% commission if you bring us your client, to, hey, come on, 3%, 4%, 5%. And we have homes ready to move into. Well, like Greg said a year ago, power position. They didn't like us. They didn't need us. But those that have been in it long enough, like Greg and myself, know it's going to turn and they're going to need us. So how do you not offend us? Well, you go through the tough times with the people that bring clients to you. And we all know who the builders are that took care of us. We all know the ones that kind of threw us away. And your client says, show me some new homes. Well, guess which way we go first? So it all comes out, and every point Greg made is right on the money, man. I just couldn't agree more. Power position is changing. I feel the market's more healthy. I am showing local buyers homes, and it is nice to feel you have a chance.
Right.
The other thing that's changed that it's with the prices that have gone up, and now interest rates have gone up, payments have gone up, and for those borrowers on the edge, FHA, VA, sometimes, not necessarily VA, but FHA, they don't have a lot of cash. They're still in a tough spot. They can come up with down payments, 3.5%, but their payments have gone up $600-700 a month, and their income hasn't. And that goes back to you as a lender. You approve them for so much, and they can afford it, but because they can afford it doesn't mean they want to spend it. They have kids. Inflation's going through the roof. That's a horrible thing. And it's affecting everybody on how much they can spend for a house. Obviously, if you're a well-off buyer, like Greg was saying, conventional loan, I'll pay for the survey, I'll pay for this, I'll pay the difference if it doesn't make, appraisal. They're fine. And realtors with upper end clients are going to continue to do fine. But a lot of this market is not upper end. The majority of people don't have $20,000 in savings. So they have good credit. They want to buy a home, but it's tough still on them. So, but in general, yeah, amen, Greg, right on the money, man. It's a little more healthy today than it was 3-4 months ago, and a lot more healthy than it was a year ago.
And like you said, FHA and VA buyers right now have an opportunity to pick up some homes because in the past year, they just didn't. They weren't competing. I had 2 VA loans on my listings that made it through, and they appraised, no problem. It was beautiful to see the veterans being able to buy homes with their VA benefits again.
Amen to that. Hey, Thom, you're being awfully quiet, brother. What do you think about this market change? Are we seeing the same thing? Are you seeing something different? What's an indicator that you can hang your hat on?
Well, excuse me. You've pretty much hit upon the points as far as just the touchy-feely thing. People going out and having an opportunity. I think the biggest indicator is the lack of multiple offers like we were seeing, meaning that it's reached its saturation point. Consumers are at the point where I'm not going to get into this craziness. I've got to wait and figure this out, even though my rent keeps going up, and they're just feeling that that there's kind of an end of any of these types of situations, and it helps that the mental part is being approached with real estate professionals like Greg going to them and saying, look, you may not be the same crazy thing we saw 2 years ago and a year and a half ago when he takes a listing. So it's really just, this is the way. And of course, I've only lived through 182 of these different market changes in my lifetime. It's just part of,
I got to ask, how did you sell those cavemen? I mean,
what we did was we staged the cave, and then we realized at certain points we didn't need to stage the cave anymore. We just threw the bones in the corner, and they said, wow, they're living high on the hog here with all those bones in the corner, and they'd buy it anyway. So it's it's just one of these things that, in real estate, what goes up comes down, and then what goes down goes up. And that's the beauty of living in a capitalistic society. You never have any perfect timing for anything as far as you go. But I will say I bought some high treasuries this week, and I thought 9.72%. Yeah, I'll do that.
Yeah. Well, I got to ask our realtors, how do you handle the person that says, okay, it's time to sell, we're ready to sell, but across the street they sold for $55,000 over asking? How do you handle that? How do you educate people on, hey, the market has changed? It's not going to, we can't just price it low and expect a lot of competition to raise the price out of the world. It's got to be priced right. How do you help people educate after this last 2 years of craziness? Outside investors, home flippers to cash buyers. How do you get them educated? What do you do to talk with them now?
Go ahead. I'll use our guest.
Yeah. I'll use this last home we listed in Summer Creek Ridge as an example. So high clutter. This family is awesome, beautiful family, and they've been living in this house for 20 years now. It was their first home. And I mean, when I say clutter, it was high clutter, very, very unique colors, right? But it was a good home. I mean, the bones were great, and all it needed was some paint and decluttering. Now, they didn't really want to do anything. They wanted to just put it on the market when our first initial visit. And basically, we had to have that expectation conversation up front. Like, regardless of what's happening in the market, we have to. If you want top dollar, they wanted $400,000 for their home. They wanted to list at $400,000 because other homes in the past 3 months had gotten close to it, $390,000, $380,000, and now these homes were a little bit bigger and not really comparables for what they're wanting. But that's just the number they had in their mind that they wanted for their house. So what we did is we went in with not just sold data, but we went in with active data. There was an active home on the market that was around the size theirs was that had been sitting on the market for 25 days. That was priced at $400,000. So we took an active comparable home in the neighborhood that wasn't selling, that was really in better condition than their house, better staged. And we let them know, look, the reason this home isn't selling is because between these homes selling and this home being listed on the market, something major changed in the market, and that was interest rates. And we had to educate them on the interest rate hike because they didn't know or understand it. So basically bringing the data and showing the proof as to why we need to list at 350 versus 400. Luckily, they listened. And people aren't going to listen to you unless you can prove it to them usually. Some will just take your advice for it and say, you're the expert, we trust you. But a lot of people really need to know the facts and the data behind why you're saying, hey, we need to list your house $50,000 less. And then ultimately, we communicate to them, look, guys, it's your home. we're just here to give you advice and help you. If you want to list at 400,000, that's up to you. But we're probably going to end up in the same boat that this other home that's been active on the market for 25 days, and you're not going to get your brand new David Weekley home. So they listened to us. We got 5 showings, 1 offer, something like 2 offers, 1 offer, but 1 was open door, so it didn't count. So I'm glad they listened to us. They painted, they did everything right. And that's how you just have to show them what happened before, what happened in between, and what's going on now.
It's the same thing as when the market's going up. You tell the truth. The numbers don't lie. You have the active numbers are real. Sold numbers are real. Dates are real. The media's out there telling everybody. And so they do watch TV or they're whatever, and they're hearing a little bit about it. So just stay with the truth, the facts, the numbers, and it works out pretty well generally.
My question real quickly, you said the house needed, did they work with you on staging and cleaning and getting weird colors changed to do that?
Yes, we provided a stager, a professional stager. I like to be the good cop and let the stager be the bad cop. And
there you go.
Allison Parsons, she's amazing. A little plug for her there. But she came out and gave them a to-do list of what needed to be done. And, she's third party unbiased, so she just does her job. And they moved everything out, everything. They're living with family, but they staged it properly. They hired my painter Rogelio to come in there and paint. And it looked phenomenal. It was a totally different house.
I think you did something right. You gave them the motivation of saying, hey, you want your David Weekley home. You want your new home that's being built for you. Here's what you got to do to sell it in this market today. The wants and needs and desires. It's just like people that I talk with about interest rates and how much interest rates are changing. I still think it's a great market because I bought my first home at 13%. So, for me, this is still a great market for people that have just started looking inside, and we've been at 2.5 to 3 to 3.25, 3.8, the changes for them are dramatic and it's going to cost. Yes, it takes down your buying power, but it's still a good purchase, especially it's an investment in you as opposed to rent. If you want to pay rent, that dollars will never come back to you. At least an investment in a home, it will come back to you ultimately. And so, Tom, I really wanted to touch on this. Mortgage-backed securities are bouncing around. People assume the Fed is raising. And what do we mean by bouncing around? We have literally seen in the last 7 days a 207 bips or 207 bips move for rates.
Which just so our listeners understand and can put it in perspective, we haven't seen a change like this dramatic, this much since 2008 in the recession. And it's been 13, 14 years it's been since we saw that dramatic of a move in a 7-day, 10-day period.
And so with that knowledge, people assume the Fed rate impacts mortgage-backed securities. Can you help our listeners understand where does the real impact happen on mortgage-backed securities as opposed to fighting inflation, the Fed raising their rate, that sort of thing, please?
Well, the irony of, tying things to the Fed rate is really used for car loans and credit cards and that type of deal. Those folks are sensitive to the Fed rate. Our market for mortgage rates is done on a separate, different platform totally. And when we get into the underlying treasury bills that are kind of tied to how our mortgages and mortgage money is sold, it's, the only thing the Fed really did back when rates were to keep rates pretty much low was to guarantee that they would buy it. And so the government, the sucker taxpayer, ends up with a bunch of low interest rate loans in this big, huge portfolio that, the Fed has stopped doing that. And as a result, what's happened is the general marketplace, the investor with MetLife or the investor with a pension fund out of Fort Worth, I say that because my nephew works there and he buys mortgage-backed securities. When they look at it, they start going, wow, we can get bigger yields. It's market competition for it. It's supply and demand. And by leaving it to the supply and demand and getting the Fed out of buying mortgage-backed securities, that's opened it up to where we have a kind of a more normal market where we see these wilder swings. I mean, I was raised in the time when I first got in the mortgage business where rates were 14.5%. Well, it was just supply and demand. Hey, I'll pay 15% for a mortgage, or I want a 15% mortgage. This is investors talking. If I can get that, I'll go throw that out. And the other investor getting 14.5 goes, yeah, well, I want 15 too. So it's really a supply and demand driven factor behind it rather than the government having influence. Well, and it's not the government. The Federal Reserve is not a government entity. I remind people about that all the time.
Amen.
It's, it's owned by the member banks, and member banks have been sitting here for about a decade going, when are we going to finally get some higher yields? So, it's just a supply and demand thing, and we've come full circle with regards to that. And it's hard to understand because, of course, the media impresses upon us that it affects the mortgage rate, and that's misinformed. It's not. It's their credit card, our car borrowing rates. It's the rate that is actually exchanged between banks as far as their them buying securities to keep enough cash on hand and that type of thing.
Well, where do you see right now? I'm seeing rates are going to be coming down in Q4 of this year. Would you agree with that assumption, that estimate, or would you disagree? What are you seeing?
I got my crystal ball out yesterday.
You're making Greg laugh.
That was almost bad.
Kind of sounds like a Styx song to me.
It does, doesn't it? I got my crystal ball out yesterday and was looking into it. And, there's not really a rhyme or reason. I would say demand will diminish somewhat, which will moderate the loans. The interesting thing about this, and this happened way back in 2013, rates jumped for a period of time substantially. And 6 months later, I was getting calls from people that said, hey, can you refinance my mortgage? And I'm like, oh my gosh, they're going to claw back my commissions and yada, 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 which they do. Investors have a written guarantee that with your, when you create a loan, that if you refinance it within the first 6 payments, they can take back the monies that they gave you. So it's kind of interesting to see, will that happen again? I think the market is set to possibly do that because demand may drop off, meaning that we'll see that competition of a lower rate to do that. But I would really like to see it higher for just a little bit longer, to be honest with you. I mean, going through the winter and getting back into next year, a 5.5% rate will have a more lasting effect. But people are exposed to so much information. It's just like you going in and talking with people about markets changed. You're going to have to really work to get this house sold. You're not going to have 10 offers. I mean, that comes directly from us because we're front of the line people. And, again, I'm not trying to hedge on my bets here. I'm just saying it's so hard to be able to tell whether or not the supply and demand will affect us and create a lower interest rate environment. But if it does, all those people that did 5 3/4 mortgages, they're going to be all happy.
Yeah. And again, the biggest thing that I see is what's going on in the stock market. If we're going into a recession, what happens to stocks? We've already seen a lowering of employment. We've already seen a slowing, a pause in hiring. So I see stocks being impacted. Therefore, indirectly, the investors are going to be jumping into MBS. And
that's one of the things that have been driving the market at this point. When stocks come down, and we have a bear market officially, we've got a 20% correction in the market at this point, stock market, that money flies to safer investments, which are home mortgage-backed securities. And so that has been, I think, part of the result. That's another driving force in the fall. You ask about, well, the bear market, and keep in mind, again, the stock market is all those traders making millions of dollars trading stuff. and they're not really reflective of necessarily an economy. Sometimes they act like it's like a daily basis type thing. Oh, today we saw the number of this blah 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 come out, and then they go and then the next day they go, oh, the number of this came out, and they go, yay. So you're just always confused with the fact that it's such an emotional roller coaster. You got to kind of take it into long term with the fact that we're already done the 20% correction. How much more could we correct? I would hope not too much more as far as the stock market. At least I'm kind of hoping and betting on that.
Well, we've also seen the inflation being impacted by the world inflation.
Absolutely.
In America. And we have to realize that Fed is trying to fight inflation here, but the world is trying to fight inflation almost everywhere. In fact, just as one indicator that is critical to the U.S. dollar, if you realize the euro dollar, which normally runs around 1.65, 1 point all the way up to 2, it is now running par or equal to the U.S. dollar, and in fact is estimated in the next 2 weeks to go below.
So, yeah, a great time to travel in Europe.
Yeah,
that euro is on par with the dollar. That's amazing.
Yeah, that is amazing. So a lot of things going on in the market, and guys, so help those listeners that are understanding or wanting to educate. I'm considering selling. What are the key questions? Because you've got to find that driving force, like you did with them buying their home. That was a key indicator for them to be listening to you, to be successful. Has most people missed the opportunity to sell high right now? Are we in that mode of it's on a downturn? Hey, you're not going to be selling high for a while, or are we going to see just a little bump because of the vacation summer, and it's going to come back up in the early, later summer, early fall area? Either one of you.
Yeah, selling high is kind of subjective right now, because the equity increase in these homes have gone up so much. Even if, like, the home that I had listed at 675, they ended up selling for 630. And because that was where the offers were coming in at, and but they were still super happy. They bought the home at like 400,000. So, you have to look at what you bought it for. And you have to look at how long you've been in it, how much equity you have in it. If you're still netting way above what you bought it for, net profit on your equity returns, then like I said, it's subjective. So yes, you're going to miss selling at whatever number you want right now, to where it's up to, something that's palatable, but you're probably going to be missing out on maybe 20,000, 30,000 at the most in those higher markets. In the lower markets, maybe 10,000, 15,000. Now, my clients wanted 400,000. We told them 350. They got an offer for 380, and they're super happy with that, right? So it did come in above and beyond, but they didn't get their 400, but they're super happy with their return. So it's hard to answer the question. Just depends. Every situation is different.
Yeah, where do you want to live? Where do you want to go? Is your job changing? Are you retiring? And people live lives, and they're going to live them whether the market's good or bad, and you still have to up and go. So if you can't sell your house for the money you could have sold it for in January, then you're certainly going to get a better deal on the house you're going to. And so it all kind of works out. The people that really hit the jackpot were the ones that are just done with houses. The last one I sold in where the market was really nutty was a $580,000 list, and we ended up getting it for $660,000. My buyer was extremely happy. And now, he's like, he doesn't care. They got what they wanted. They paid what they could. So by that, guys, everything is going to be worth what it's, what somebody will pay for it. That'll never change. Houses, even in this market, that are extremely perfect, you still get a lot of interest. You still get offers that are, at list. The comps are coming down a little bit, so lists might be a little different, but it can still go over a list if it's the right house in the right area. So, and I think the market is getting healthier, just personally. I love buyers are back in play. I love that all loans are back in play. Asset management companies are in play, and that's been a big change over the last year and a half, 2 years. They're buying a lot of percentage of the properties, and they're bringing cash and they're bringing a lot of it. And so we've had to deal with that. But in general, I'm with Tom. I kind of want the hardcore press to continue just a little bit longer. And I think we're going in the right direction. I know buyers are breathing a sigh of relief. Greg will tell you, when you have a listing a year ago, you get 25 offers and 24 really upset people.
Oh, yeah.
And you can only be upset so many times. And so those buyers take a break. And as a realtor, it's our job to stay in touch with them, keep them up to date. We're back in power. Come on. And out we go. And we're showing again to those folks that for a while are like, I'm done. The apartment ain't so bad. Or, the landlord, I actually like the person, whatever. So, they justify. But I think it's getting better gradually. And I'm good with it.
I think it's funny.
That's great. And I want to remind our listeners that you can find us on multiple platforms for this blog. Please go there, like us on KVGI Media. In fact, there it is, Apple, Google, Spotify, so forth. WelcomeHomeRadio.net. You can find all of our radio shows there. Like us, ask questions. What an opportunity in the market today as we see this transition. Talk to our professionals. These realtors know and can answer your questions so you can make the best decision for your family, because homes are the investment. It is not a burden, not a debt in my mind. I try to make mortgages out so that they're understood to be an investment. And I think a lot of people are seeing that as continued prices, values of homes, we will not see, because again, supply and demand, as Tom put it, we are capitalist society for the most part. Supply and demand is going to require if supplies are there, price is going to go up and continue to. So if you were in the market, weren't able to come back, at least investigate it, contact Greg, contact Alan, make them aware of your concerns, questions, so that they can answer for you. Guys, what can we leave them? What else have we not covered that we want to touch on?
I was going to piggyback on what Alan was saying to leave it with.
I'm sorry?
Can you hear me okay? Sorry.
Yeah, no. I'm sorry I interrupted you then.
No, it's okay. I was just going to piggyback on what Alan was saying, how the conversation has kind of shifted from going into helping someone list their home and telling them, look, you're not going to have any worries. Let's just do this and that, and let's price it at what you want. And let's go. Now that conversation has changed, like we've talked about, to, okay, we got to look at all this data as to why we can't get the list price you're wanting. But on the flip side with the buyers, it used to be, okay, guys, put on your helmets, put on your war helmets. We're going into war. You have to set their expectations for a battle and for perseverance and rhino skin. And, we're not going to let this market beat us. We're going to beat it, and we're going to see it through, and we can't give up. It was like this whole pep talk I had to have with them before we went in and started looking at homes. And now that I don't have to have that conversation anymore. So I'm not really having to have that conversation on the list side either of, hey guys, we got 50 million homes on the market and we really are going into war here. So it's really healthy because we're having normal conversations with buyers. We're having normal conversations with listings, setting expectations. Sellers setting expectations are not so crazy. They're just more normal, more healthy expectations to be setting. So I agree with Alan that we are heading into a healthy market.
Well, I think it is setting expectations, availability, understanding, asking all the questions. And I'll be honest, if you're watching the news, if you're watching any of the market on the mainstream media, please talk to a professional. They give you a very generic view and they do not know your local area, and that will impact you. Be aware of these key questions because so many people, as Tom put out, so many people think the Fed is a governmental entity. No, sorry, they're not there. They are run and owned by the banks, and they are managed, and a lot of things impact. And again, the hardest thing they've done over the last 2 years, Tom, is, like you said, buying mortgage-backed securities consistently at $1 billion, $2 billion a month. That has caused where we're at today. That's why the interest rates have jumped up so quickly. Instead of just enjoying a short period of time, we enjoyed a much longer period of 2.5%, 3% for a long period. So leave your questions at welcomehomeradio.net. Greg, thank you for joining us today. I am so grateful for your time, brother.
for having me,
And
buddy.
let's get out there and go play some golf soon. Gentlemen, thank you so much for your time and have a blessed rest of your day. I'm Blair Thomas.
I'm Thom Hulme with Champion School of Real Estate.
I'm Alan Pace.
God bless. Have a great rest of your day and stay cool.